Have you ever come across an investment that looked promising only to realize the rules and risks were completely different than what you were used to? In this episode of the Passive Income Playbook on the Best Ever CRE show, we are diving into one of the more unconventional quarters of the real estate debt world, which is cannabis lending. I'm your host, Pascal Wagner, a full-time LP and founder of Grow Your Cash Flow, where I help investors build a passive income plan, filter through deal flow, and invest with confidence. And I've reviewed over 75 different debt funds this year alone while researching kind of the best evergreen opportunities for my community. And one fund that stood out was MJ REIT, which is a cannabis-focused real estate debt fund with a unique lens on lending in the market. And so today I am joined by Reece, founder of MJ REIT, to talk about the current state of cannabis, how their Evergreen fund is structured, and where he still sees upside despite maybe some of the stalled federal legalization. So if you're exploring niche strategies or just want to understand how to evaluate specialty funds like this one, this episode will be packed with insights. And with that, I'd love to welcome Chris.
Pascal, thank you very much for having me. I'm excited to spend some time today, not only going through, sort of the fund overall, but hopefully provide some insightful commentary that's of value to your listeners. So thank you in the beginning for having me.
Yeah, I'm excited to dig in here. Cool. So we've already spent a little bit of time together, me and your team, kind of learning and just understanding how your fund works. I've invested in a similar fund, the Polaris Capital Group, and so I think there's going to be some interesting things that I'd love to pull out here for the listeners who are maybe just unfamiliar with this space in general. So I know we're going to get to fund structure here in a bit, but first I would love to just start with your personal background and how you found your way into cannabis lending so that our listeners know who they're talking to.
Yeah, I guess we all have interesting backgrounds, but I've been in the institutional asset management space for almost 30 years, half of those on the public side. And I started at a large firm now called Vanguard way back in the 90s. And it was interesting because at the time, we had built what we thought were very well diversified portfolios. And then the tech crash happened in early 2000, and global correlations went to one, and the diversification that we thought we built for investors went out the window. And so I am a believer in the public markets firmly having a place in just about everybody's portfolio. The size or exposure certainly varies upon investor. But I transitioned into the private asset space really because I looked at it as an area to dampen that volatility, increase the diversification that one can have, and provide or enhance returns. So I started with a firm called FS Investments. We launched the first private BDC. BDC stands for Business Development Company, which essentially helps facilitate the flow of capital to small or private U.S. companies, and raised a bunch of money and did a number of deals. And when I left my last firm, I looked at why those BDCs were so successful. And it really gets to the point that we had a disappearance of middle banking in America. And that still goes on through to today. And you had a high demand for capital. So you had high demand and you had lack of capital. And that created a lot of opportunity. And you saw the BDCs, private credit funds, shadow banking pop up in 2008 and continue through to today. So when I left, I looked at a number of different industries where I could find similar characteristics. So once again, high growth and a limited amount of capital to fund that growth. And I looked at infrastructure funds, oil and gas, gold and precious metal, even crypto. And I kept coming back to the cannabis area that had not only those two characteristics, but also a third, which is a limited exposure on the institutional side. So cannabis, for its part, remains one of the fastest growing U.S. sectors. It has limited access to traditional financing. You can't go to Wells Fargo to get a mortgage. And there's a limited amount of institutional players. And so with those three characteristics, if you can find those, regardless of the industry, it tends to be a good way to generate better risk-adjusted returns for investors. And so when I started MJ REIT, I didn't want to lend to an operator as a balance sheet loan because pretty much in any industry, but specifically within the cannabis space, that can be a really risky proposition. But rather what we focused on were hard assets and real estate being the crown jewel of those hard assets. And so we focus on lending, and we'll get into the fund in a little bit, but that's really the background. And I looked at the opportunity to create a solid structure and generate better risk-adjusted returns. So it was kind of a combination from a long history in the public markets and then transitioning to the privates, really that got me into the cannabis space overall.
And give us an idea of how long ago you started this, maybe the fund size today and how many investors you have.
Yeah. And so I started in the summer of 2022. We launched our first full month was in September of 2022. So we are about 5 weeks away from our 3-year track record, which I'm really excited to get across that 3-year number. So super excited there. The fund continues to grow. So right now in the fund, we have a little more than $7 million in total capital. I'll take a step back and I'll explain in a little bit more detail shortly, but the overall strategy assets are north of about 170 million. And that's made up of a few institutional funds alongside MJ REIT. So we have about 170 million in total. And today, inside of the fund, we have exposure to 8 states. And we'll talk a little bit more about some of the diversification shortly.
I love it. Okay. So first, can you help take us a step back? And someone is putting their LP hat on. They're listening. They're interested in learning about different opportunities. Can you kind of high level tell us about lending in general, and then maybe the nuances of cannabis lending as opposed to just a traditional debt fund that an LP might invest in?
Well, it's interesting because given the fact that you can't go to a bank, it creates an enormous void of capital within the cannabis space. So just think about, if you had to go and get a mortgage and you couldn't go to Wells Fargo, but you had to go find somewhere else to get that loan. So when capital is scarce, those providing the capital can be somewhat creative with the way they finance and also the rates that we charge. And so that's the big caveat between kind of what we do and why we play in this particular space. But I think the most important aspect of how we approach each one of these deals, and this gets to this notion of cannabis and the risk associated with cannabis, is that in every transaction we underwrite or originate a senior mortgage on, we assume that cannabis goes away and we need to find an alternative use tenant for that property. So think, for example, on the industrial side, we have a cannabis cultivator and the cannabis cultivator defaults and we need to replace that tenant. Well, if I assume I have to pigeonhole myself only in finding a cannabis tenant, the number of potential re-tenants goes down because there's simply not that many out there. But if I have the valuation assigned on the property at such a low number that I can cover my debt by lending or getting an alternative use tenant, non-cannabis tenant in, and still cover my interest obligation, then that's exactly what we look for. And so we've continued to essentially get compensated for the cannabis risk without actually taking that cannabis risk. And I can go into a little bit more detail about that. But really, the unique aspect, Pascal, and this is, you think about an industry that has, number one, it's not legal on the federal level, right? So that's a challenge. But number two, it's not even legal in every state. So you have 41 states, DC, and a few US territories that have at least a medical program. And those are the opportunities that we're seeking inside of the fund.
So I'm picturing, okay, if you are in a state in your life where you are interested in fixed income or some sort of kind of monthly or quarterly distribution, you might fill out your portfolio with certain funds that might do fix and flips, and that you might then invest in a fund that does loans to commercial multifamily operators. And then one of the options, if you are looking to diversify your portfolio, is one option, at least that I've chosen, is to invest in having the cannabis niche. So can you walk us through like you highlighted it a little bit before, but kind of go through the story of if you are a cannabis grower, like what is the process that you're going through in order to find a loan and to grow a facility, and talk a
Yeah.
little bit more in depth about why they might not be able to get these loans federally, and there's it's on the surface it sounds dangerous that they can't get these loans federally, but once you understand that risk a little bit more, that kind of risk goes away a little bit when you understand the niche. Can you talk to that a little bit?
Yeah, yeah, absolutely. And a lot of the cannabis operators are self-funded or have raised capital through friends and family, because you can't go to those banks. And the reason that you can't go to the banks is that cannabis is still on Schedule 1, which means it's illegal at the federal level. And Schedule 1 controlled substances, there's cannabis, there's LSD, and there's cocaine. So you have these like very bad drugs, but then in addition to that, which simply means that they have a high tendency for addiction and no medical benefit. Well, you could argue, as many have and will continue to argue, that there are proven medical benefits with the usage of medical marijuana. So that the whole idea of getting cannabis rescheduled, which we'll talk about as well, is certainly out there. Probably not going to happen for the foreseeable future, but eventually I think it will make its way and either get to a Schedule 3 or maybe be non-scheduled at some point. But because it's still getting back to the lending component, so because it's still illegal on the federal level, banks aren't willing to participate. Because if you did, and there are some banks that will accept deposits from cannabis companies, but if you did, then you need to file a suspicious activity report for every dollar of movement, which simply means at a bank level, you need more compliance, and more compliance means more cost, and you're trying to run a profitable business. So not many banks have gotten into the cannabis space, and that will change eventually with the reclassification at the federal level. And so because you can't go to those banks for any type of lending, that's when you come to funds like ours or other funds in the marketplace that make it their business to step in and fill that void of capital in the market. And we really fit inside, and you kind of hit on this passive aspect. So we really fit into an investor's portfolio on the passive side, because every month we're generating that consistent above market monthly income. And we offer and provide good diversification to your other real estate components in a portfolio. So think about maybe mobile home parks, value add multifamily, and we kind of fit in that sleeve as a continued diversifier of a real estate portfolio. Or conversely, we've had a number of clients that use us really as a fixed income alternative because they're looking to capture a little bit more monthly income to live off of. So we have a number of investors that are taking advantage of that component as well. And so as things continue to change on the federal level, I would anticipate that at some point there will be more banks that will traffic in the space. And with any industry, as capital comes in, the cost of capital goes down. And so today we're lending, and we'll talk about some specific deals, but we're generally lending on a short-term senior mortgage at rates anywhere between 13 to 16%. And so while that sounds fairly high in the market to non-cannabis, when you need money and you're going to earn a multiple significantly higher than that, then you're fine paying a little bit higher because you need that capital to grow your business. And so we have no shortage of deals. We're constantly in the market looking for new deals, talking to everybody, and then really conducting a thorough due diligence on every one of those properties before funding. But at some point, Pascal, we will get some competition on the bank side and rates will come down. And I tell our investors, and because we don't have a lockup, this is a strategy that's designed to take advantage of a unique opportunity in the market that won't be around forever. The fund itself is evergreen, but putting money into the market at 15% is not always going to be the case. And eventually we're going to be putting money out at 9 or 10% as the market matures.
Yeah, I think you hit on a point there, which is a key theme, which is like, it's important to kind of understand how an operator or a given fund or investment, what that future and what the point of time is of where that opportunity is available, right? So like there are so many operators out there that are touting that their asset class is the best thing since sliced bread, regardless of if you are in the back half of 2008 financial crisis,
Yeah.
if you're in the run up, or, because they're operators, it's their business, it's what they need to do. But like you said, there are opportunities or points in time where these types of opportunities are available, and that's what you're taking advantage of now, and that may not always be the case. So I love how you kind of broached that topic. Can you talk to us a little bit about give us a little bit of a frame of how the fund is set up? Maybe, I know that you guys have done double-digit returns to LPs every year for the last 3 years, if I have that right. And and maybe just talk to us a little bit about that structure. So for those who are listening can understand if this is a unique thing for them.
Yeah, and one additional point, and I'll hit on the fund structure, which you kind of brought up as well. But you think about the difficulty from being an operator within the cannabis space. So take real estate out of the equation for a second, and just imagine you and I opened up a dispensary, and we're licensed to sell in the state of New Jersey. Well, because cannabis is illegal at the federal level, you and I can't deduct ordinary business expenses through IRS 280E, which means that we're paying effective tax rates north of, in some cases 70+%. And so as any business in any industry, startup that is, it's tough to make a go of it. But in particular within the cannabis side, because the tax rates are so high, because you're trafficking in a federally illegal substance, it's really difficult. And that's why when you think about underwriting it, just a piece of real estate, which we do on a non-cannabis valuation, it's still critical for us to understand the viability of the operator that'll be the tenant in the building. How long have they been in business? What's their track record? Have they seen a market cycle? How deep are their pockets? Because this is it's tough to get this business going. On the fund structure side, it's interesting because we launched this as 506C Reg D offering and taxed as a REIT. And so there are some tax benefits that we can talk about to our investors. But really, we're focused on an evergreen strategy. And when I created the strategy, I really wanted to focus on making it as simple on both the purchase as well as the redemption side. And so we have monthly purchases, we have monthly redemptions, we value the fund on a monthly basis, and we pay monthly distributions. And so our since inception track record, annualized net of fees and expenses, comes in at 11.27%. And the goal of the strategy, because we're really focused on above market passive income, we're focused on a 10+% annualized distribution that's paid monthly. And we've been as low as 10.2 and as high as 16.67. And so we check that box for above market income every month since we've launched. So I think for me, I've seen a lot of strategies that haven't worked out in the marketplace. And I think part of that maybe is the wrong structure or maybe the wrong investments. And I think the third is setting the wrong expectations. And so we're very clear with our dual mandate, which is price stability and above market income. And we've been able to execute on both of those every month since inception.
Yeah, I mean, I think so. I'm going to just go on a little bit of a tangent here to talk about some of the things that I've learned. And I think they're important when someone is analyzing a fund like this of, when you're comparing a bunch of these different funds side by side, a lot of the questions that come to mind for me are, okay, how long has the firm been around? When was it founded? Your firm has a preferred return, which is always kind of great to see if you're an investor. Looking at the last several months or several years of hitting double-digit returns, right? I'm always looking for consistency of returns. I love that there's no lockup period. I think it's a low investment minimum. I think you even allow just $25K.
Yep, exactly.
Yeah. And, it's all senior first position loans instead of, maybe adding some preferred debt or second position stuff. There's no leverage in the fund.
Right.
You mentioned that there's the REIT, the tax benefits. Yeah. So instead of getting your interest that you earn, instead of that being taxed at your ordinary income, it's taxed at what I believe is long-term capital gains at 20%.
And essentially what happens is you're only paying taxes on 80% of the distributions that we pay. So, if we pay you $100, you're only paying taxes on 80.
And then, so I think in general, like whenever you're thinking about investing in a debt fund, those are a lot of the questions that I like to ask. I think the only knock that I have is that there are no audited financials, but I think that's probably due to your size. It's cost prohibitive to have audited financials at your size.
Yeah. And the goal is once we cross that $10 million threshold, so we're getting closer, we'll get those financials audited as well.
Yeah. Can you talk to us a little bit about your acquisition and underwriting process? What are the steps and along the way, what is a no and what do you like to see?
Yeah. And so it's a great question. And I get back to the idea that we want to and we're willing to talk to everybody because, the cannabis is no different than any industry that there's a lot of deals, but there's maybe a shortage of good deals, right? And it's our job as managers to sift through those deals to find the good ones. And what does a good deal look like for us? Well, a couple of things. You go back to the notion that when we evaluate a property, we're not on the surface taking the cannabis valuation into play, meaning that once again, we assume that we got to, kick out the cannabis tenant and bring a non-cannabis tenant into the equation. So if you're a non-cannabis tenant, you don't want or maybe don't want to pay for or don't need a lot of the additional improvements that the prior tenant brought in. So by us not including that in the valuation on our LTVs or loan to values, that automatically kind of takes that loan to value a little bit lower in the market and allows us ultimately to have a higher probability of recovering our full principal should we need to come in and foreclose on that property. So really the diligence is what you would do in a standard industrial or retail property, right? It's a proximity of the location to highways. What's the geographic population look like? Are there other competitors? And the unique component with cannabis is that it's licensed or sanctioned by the state. And so you actually have to have approval and get a license to either grow, process, or sell cannabis in that respective state. So there's a little bit of a barrier to entry depending upon what state you're trafficking in, because some states are what's called unlimited license, meaning that the state will issue, gazillion license if there's that much demand. And other states are limited license states, like the state of Florida, for example, that has only a limited amount of licenses up for sale or for any one person to take advantage of. So you have to take that into consideration. And we have a 7-member investment committee that collectively has over 200 years of real estate experience in both finance, origination, diligence, and accounting. So we have a deep bench on the investment committee side and the sub-manager. So we have a team that has been in real estate for over 63 years that we're using to diligence all these deals. So experience matters, and one's ability to execute on a strategy and ultimately generate that consistency that you referenced is paramount to us. And so, we'll look at every one of those deals that come in. Some of those deals are simply a no-go because I can say, hey, your property has some sort of hazard on it, right? So we're not going to get involved on that side. It could come down that you want to borrow at 11 and I want to lend at 12 and we can't come to terms. And so we'll pass that from a term structure standpoint. It could be that, we want a personal guarantee and you're not willing to provide that. So there's a lot of little nuances that come into it, but it really is the basic blocking and tackling that you would perform on a standard industrial or retail property that we're bringing to the table with our experience. And then adding to that, the little nuanced twist of the fact that your tenant, and again, we're not owning the properties, we're just providing the mortgage, but the tenant in that property is a grower or a seller of cannabis. And so you need to understand the dynamics of their prior experience as well. So management teams are always important for us to diligence as well.
One of the things that when we spoke on the phone that I was trying to hash out and thought was unique is that, so for example, a fund that I'm in participates in construction loans, whereas my understanding is that you you only focus on existing stabilized assets. Can you talk a little bit about maybe the decision and the thinking behind why you've chosen the current path and maybe pros and cons of that model?
Yeah, and I think for us, I approach everything with a risk lens and trying to mitigate that risk. And construction lending done correctly can provide the benefit is that it has a juicier return. And, I'm lending at 13 or maybe 15%. Well, maybe somebody else in the construction side is lending at 19 or 20%. So the ability to generate a more juicy return is certainly there. But to us, the way I wanted the strategy to work is not necessarily, I wanted it to be a component of somebody's diversified portfolio. And certainly there are a lot of opportunities out there to earn 2 or 3x your money. We wanted the strategy just to be that consistent, help you sleep at night type of strategy where you can rest your head on your pillow and know you're getting your above market income clipped on a monthly basis. And so for the fund itself, it's really, we went down a path of operating in a sector that has risk, and we've continued to look at ways that we can de-risk that. So the alternative use valuation, as I mentioned, lending on stabilized assets is another way to help dampen that portfolio risk. And again, this is not a knock against construction lending because they're viable strategies, but it's just a different risk profile than what we wanted inside of the fund. And so, you're giving up potentially a little bit of return, but for us, you get to sleep maybe a little bit better with their head on a pillow at night.
Can you talk to me a little bit about how you view the current state of the cannabis market? What's working, what's not? Give us the lowdown.
Yeah, and it's interesting because if the election would have turned out differently in November of last year, Harris was much more favorable to the cannabis industry. And while that may not have necessarily been a great thing for us because we're in this gray market right now where we're taking advantage of the scarcity of capital on behalf of our investors. But certainly Harris would have looked to move to federal legalization probably faster than the Trump administration. With the Trump administration, he actually voted for passing recreational or adult use cannabis in the state of Florida, his home state, even though it did not pass. So he was coined as a kind of a pro cannabis, if you will. However, as we've all seen, there's a lot of other things going on right now in the administration, and legalizing cannabis is certainly not one of the top 10 or 15 or 20 or maybe 50 that he's focused on. So for us, we look at it as at least the next 5 to probably 7 years that we're in the state of really just this gray area where there's no true direction. And that true direction is good for us because it keeps banks out. But it's also, listen, there's a proven medical benefit for PTSD, anxiety, and a whole host of other ailments that cannabis can assist with. So by not having the banks come in or the cost of capital being higher, that somewhat stifles the growth overall. But where we've seen big opportunities is when you see a state go from typically goes from zero to a medical program and then a medical program eventually to an adult use program, which is synonymous with recreational. So when those states make those moves, you see the total addressable market increase. So you're at zero, then you go to medical, so then you have a bigger chunk. And then when you go to adult use, it's even larger because there's simply more people that can purchase cannabis. And so when that happens, cannabis is an area that you can't AI. You need physical real estate to grow, process, and sell. And that physical real estate is governed by the local municipalities and the state overall. So it creates this opportunity for us that when these states come online and go from zero to medical and medical to adult use, the demand for that real estate increases. And so we're capturing that in the fund. And even though we don't necessarily own the properties, it's better for the industry overall. And we'll continue to see that grow. We look at the state of Pennsylvania that Governor Shapiro has tried for the last 2 years unsuccessfully to increase or take on adult use of cannabis, the state of Florida as well. And there are a few other states where over the next couple of years should look to legalize. But let me put it to you in this way, from a total sales standpoint. So in last year, cannabis sales on a national level exceeded $32 billion. This year, they're expected to exceed $35 billion. And that's the legal market. If you were to look at the illegal or illicit market, and nobody really knows the exact numbers here, but it's estimated that that would add another $70 billion to sales. So just conceptually, think of this as $100 billion industry. And that is on par with tobacco and alcohol. So it's an enormous area of the market, and it's only going to continue to grow as more states come online.
Why hasn't it federally legalized, or why hasn't federal legalization materialized? And how has that kind of affected the industry overall? I'm thinking a lot about, if you were in this industry or niche in the making an equity play, you would, if you held a cannabis stock over the last 5 years, I imagine a lot of people have been anticipating the legalization. And so when that doesn't come through to fruition, at least the portfolios I've seen, they've not done so well.
Yeah.
I'd love to understand if you feel similarly, but what's interesting about the way you're playing it with debt is that it really doesn't matter to you from a risk perspective how the industry performs. If anything, maybe your fund will wind down or just provide lower returns because the opportunity is significantly less.
Yeah, it's exactly right. And over time, as more capital comes into the market, that cost of capital will come down. But when you think about the legalization on the federal level, so there was a movement by the Biden administration where he tasked the Department of Health and Human Services to evaluate if there's medical benefits from cannabis. And so the Department of Health and Human Services came back and said, yes, there is. And then they made a recommendation to the DEA, who ultimately has rescheduling power over what drugs make it into schedules 1, 2, 3, 4, 5 or non-scheduled. And so then the DEA said, okay, we're going to take a look at this. And then it got held up and got punted. And so there's been no clear movement. And where we stand today is there's really no direction as it stands today that cannabis would be rescheduled, at least in the near term. I think as things calm down a little bit and there's some additional insight put into the movement, then certainly that will pop back up, and it's needed for the industry to ultimately make it longer term. And when I say make it, really begin to flourish, because going back to that tax comment where you can't deduct ordinary business expenses as a Schedule 1 controlled substance. So if cannabis made a move from Schedule 1 to a Schedule 3, then now all of a sudden, Pascal, you and I that are operating this dispensary can begin to deduct ordinary business expenses just as a coffee shop down the street. And so ultimately, that would be good for the overall industry. And then in addition to that, you have safe banking that's tried to make its way 9 or 10 times, all the while never passing the floor. So safe banking would allow banks some regulatory oversight so that they would be, from a compliance standpoint, somewhat protected. Because when you think about the impact that trafficking in a Schedule 1 narcotic like cannabis, I mean, I don't even think today you can buy cannabis publicly traded stock on Charles Schwab. So I think it's so that's how far out the industry is.
Wow. Okay. So there's still a lot of different opportunities here, and depending on how you want to play in the space, I imagine that's where the huge maybe equity returns would come from if you played on the equity side is watching some of this become legalized, so that one, you can maybe don't pay as much tax, or two, you can write off more expenses so you're more profitable, and three, there's so many more consumers. So yeah. But in the meantime, you get to play a little bit more conservatively and still basically get some fixed income from it.
Yeah, 100%. And interestingly, the dynamics of the players within the space are beginning to change as well. And what I mean by that is, 5 years ago, a lot of the companies, what I'll say, weren't sophisticated with their CFOs or even their leadership. And now you have firms that are taking some talent from big private equity shops like Blackstone or KKR, because people see the opportunity, to your point, in the space overall, and the caliber of the people that are operating some of these businesses continue to increase. So it's an industry that's been around for a long time. I mean, it wasn't until 1996 when California passed Proposition 215 that allowed cannabis medical marijuana to be grown or sold in the state for the first time. And since then, we've continued to see, more and more of those states come online. But ultimately, it comes down to that. It's just the maturation of the overall industry and the opportunity along the way. But you made the point earlier. I mean, if you bought Tilray or some of the other publicly traded stocks 3 or 4 years ago, like you could be down 80%, right? And there's so much public sentiment because those public equities trade on future expectations. And so if there's the expectation that cannabis will be rescheduled, then you see an increase in the stock price. Where on the debt side, we're somewhat agnostic to that because all we're looking to do is say, okay, here's a piece of industrial property. We've underwritten it correctly. We have a low valuation, or our loan to values are 75%. And can you as the borrower meet your interest obligation? And so for us, it's taking this somewhat, I'll say, risky area and really focused on de-risking a lot of that outside of the portfolio and focused on a debt strategy.
So, I think when I first started figuring out what debt funds did I want to invest into, I heard about cannabis and it sounded unique. And initially I put it off for so long because to me, I thought, okay, why would I, this just even sounds risky. Why would I play in the space? And then once I started learning about it and just realized how you're not really involved in a lot of the risk, and that actually provides a lot of the opportunity for the return. What are the biggest misconceptions that LPs have? Or, I imagine your firm fields all these crazy questions from investors.
Yeah.
What are those?
And it's interesting. So I guess the biggest one is this. There are people that look at cannabis as a moral, immoral aspect. And so no different than if you don't like tobacco, you don't buy a tobacco stock unless you're just, maybe it's a good time to buy because you want to make money, a capitalist, right? So that aspect, and whether you believe or don't believe from a moral standpoint, if cannabis is right or wrong. So we get that a lot. So a lot of times I'll have a conversation and somebody will maybe just say, listen, the word cannabis is out there. And I have to take a step back and say, listen, we're generally trafficking in that area, but we're not actually touching the plant. We're not financing an operator. We're just simply providing a mortgage on a piece of real estate. And so we're still at arm's length. But that's been the biggest hurdle, is this, that I have the word cannabis in my PPM. And because I do, some people are just kind of walk away. Second is the perceived risk. And I want to say that word perceived because there is risk in all investing, right? So we'll note that. However, when you take and you get to earn a better risk-adjusted return by lending at 13 or 15% versus what I could lend at to a standard multifamily apartment complex, and do so in a way that doesn't elevate the risk profile of the fund, that to me seems like an interesting opportunity, at least from the standpoint of learning a little bit more. And, I'll be the first to say that, our investment strategy isn't for everybody. No investment strategy is. But for those that are looking for that stability and they want to take advantage of an opportunity, a timely opportunity to earn a little bit of additional income where you're not locking your money up for 6 years, right? You're not beholden on me to create your liquidity event. The fund structure allows you as the investor to create your own liquidity event.
What do you think is the craziest question you've heard from an investor?
Probably if we give out free samples after investing. If I sign the subdoc, do we get a monthly subscription to pre-roll? And especially when we're at conferences, everybody thinks that we're going to hand out cannabis, and of course we can't. But those are the funnier questions. I think a lot of it is just in joke, but it's still funny. I still get a chuckle out of it.
Yeah, when you're obviously in the space, and I imagine all the different players that are in your space. Can you talk us through what we as LPs should be thinking about if we're like, okay, this cannabis niche is interesting to me. Let me go look at all the different players and different strategies. What are the things that I as an LP should keep in mind when I'm looking at different funds?
Yeah, and I think you hit on some of them earlier, which is the manager's track record, and not just performance. I mean, performance is, performance comes and goes, right, to a certain extent, but it's the ability to manage through a market cycle. And what's interesting in the cannabis space is there are not that many players doing what we do, and we get the opportunity. When I talked about this pipeline of deals that we're always looking at, when somebody gets into trouble and they need to unload some assets, we get the opportunity to go through your book, right? And we can look at certain assets, and you might have an asset marked at $10 million. We think it's worth 5. So we'll take it off your hand at 5, and you may or may not go for it, but at least. So I guess my point is that you're aware trafficking in this industry, it is somewhat small in that there are not a lot of players. So we get to see all of these deals, and we get to know and better understand, especially when somebody gets into trouble and they need to fire sale an asset. We're one of the few people in the marketplace that are still deploying capital, which then it gives us the opportunity, getting back to the selectiveness of the deals that we're putting in the portfolio, gives us a lot of opportunity to be extremely selective in the deals that we fund. So, for us, it's that, to answer your question directly, it's really evaluating. For me, I think what's most important is the manager and their ability to generate a consistent track record over a longer period of time. And long is a relative term. I'm very proud of the track record that we've put together over the last 34 months, soon to be 35, and ultimately a 3-year number in 5 weeks. So I'm very proud of our ability to execute on the expectations that we provided to our investors and every investor at the very beginning, which is that stability of principal, which we value the fund on a monthly basis, and that above market monthly income, which we've exceeded every month since launch.
I love it. One of the things that comes to mind for me was, construction loans versus, already existing structures. Are there additional kind of nuances or additional risks that maybe you've decided not to take on that maybe other colleagues in your space have?
Yeah, and I think getting back to the construction side, it's really all about underwriting and how those loans are, whether it's construction or a stable asset loan, how they're originated. And on the construction side, let's say we provide you a $5 million loan. Well, getting those draws are subject based on your ability to meet certain thresholds, continuing to develop. So you don't just get the $5 million up front on a construction loan. It's like, okay, you get $300,000 because you're going to concrete the floor. Right. So you concrete the floor and then you check that box and then you get another draw and then you do step 2, step 3, step 4, and on and on. And so for us, that just seemed like had a little bit more risk in it, that there's a lot of additional steps along the way, a lot of twists that a potential borrower could trip up on, whereby as if you're already operating a facility and last year you generated 5 or 6 or 8, whatever million in sales, like that those are tangible numbers that we can look at and use to analyze the risk profile of that underlying investment and ultimately determine whether or not it makes sense to include in the portfolio.
This has been
space, right?
Yeah. I mean, it's there's so much. It just fascinates me, how many different strategies there are in investing and the pros and cons of each kind.
Well, it's crazy because you think about it, at its heart, it's an agricultural product, right? You're growing a plant. In essence, I mean, that's what you're doing, growing a plant. Now, you're processing it and making it into gummies, tinctures, and other, products. But like at its heart, you're an agricultural product. And with that, no different than, soybeans or corn, those values also change on the wholesale price. And so that's another component that you come into. So for example, in the state of Wisconsin, they have, obviously it gets kind of cold up in Wisconsin, and there are outdoor growers that flood the market in the fall with their harvest. And all of a sudden, the price per pound of cannabis crashes throughout the November, December, January time period because you have more product that hits the market, and all of a sudden prices come down. So it's understanding those dynamics, whereby if you just look at the space and you're coming in for the first time because you think it's a neat area, if you don't have that expertise and understand how each individual state has its own dynamics, then it's tough to it's fraught with risk. Then I would say.
Are there any nuances to investing or lending on a building that's designed for agricultural use that you wouldn't have with a warehouse? I mean, it is a warehouse, but
Yeah, and so it's interesting in getting back to this alternative use. So generally what I've seen is you and I get together, we buy a building for $2 million because we were awarded a license to cultivate cannabis in the state of California. So we go out, we buy this building for $2 million, and it's not out of the question that we may need to put $6 million in it for irrigation, lighting, HVACs, high-tech security, all the nuances that you would need to grow cannabis. So if we put $6 million in and we bought it for $2 million, like our valuation in our mind is at $8 million. But with how we approach it, we're looking at that non-cannabis tenant. So if I had to take that and replace that cannabis tenant with a non-cannabis tenant, that new tenant certainly doesn't have that need for enhanced security or HVAC, so they don't want to pay for it either. So by de-risking that portfolio, by not lending on a cannabis valuation, helps protect on the downside, and that's been some of the downfall of other players in the market that may have lent 5 or 6 million on that deal, where we're coming in at 2 or 2.25. Now, flip side is that we're going to lose a lot of deals like that, but most important for us, because we're not swinging for the fences, we're not in equity, so I can't make a 3x to make up for a loss, right? We're doing, we're giving you $1, and you're going to pay us some interest along the way, and the goal is for me to get that dollar back at the maturity of the loan. It's we're not we don't have the ability to make these outsized returns, so for us, it's critical to not lose $1.
I hear that. Chris, this has been incredible today. Thank you so much for sharing so much about what you do, MJ REIT Fund, teaching us about the niche. Where can people go follow you, learn more about MJ REIT, and ultimately connect with you?
Absolutely. So certainly you can visit us online at mj-reit.com. We're on all of the socials, Facebook, LinkedIn, Instagram as well. So we'd ask that you follow us on there. But really, my contact information is out there on LinkedIn. My contact is on the website as well. And really, we welcome the opportunity to have a conversation with anybody about what we're doing. We're passionate about the opportunity. We're passionate about generating a consistent track record for our investors. And if you believe that this might be a fit for your portfolio, we'd be happy to have a conversation. And if it doesn't work, it doesn't work, but we'd happy to have a conversation.
Love it. And if you are an LP struggling with a deal flow or would just love to see all types of opportunities out there, like the one that Chris has, I recommend or encourage you to go to we'll start out with passiveinvestingstarterkit.com. And you can go and we update it every week, send you new deals every Friday, and you'll find opportunities like the one Chris has there as well. So with that, thanks for joining us here on the Passive Income Playbook, part of the Best Ever CRE show. As a reminder, we drop new episodes every Thursday, so be sure to tune in each week for more conversations like this one to help you become a better passive investor. If you enjoyed today's episode, please subscribe, leave us a review, reach out to us on LinkedIn. We love hearing from you, and it helps us figure out how to improve the show and understand what's resonating. So with that, thanks for tuning in, and we'll see you next week for another episode of the Passive Income Playbook.
Thank you.